So, all right, let's get started in Midcap Masala today and taking a look at the markets. Once again, a good day coming in for the benchmark indices, at least because just yesterday we have seen Nifty as well as Nifty Bank recovering, while the mid and the small end of the market, especially the index, managed to end the day in the green. And a similar growth is what we are getting. See small cap index almost 0.5% higher, and even mid cap index perking up with almost 0.3% of a gain. The benchmark indices, of course, they are holding up strong. Select metal counters, select auto counters, they are doing very well. But within the broader market space, let's have a look at which are the pockets that are doing very well. Today, of course, is the AMC counters that are perking up. Select OMC counters, they are doing well. Stocks like IOC, BPCL, they are holding up way better. But quite a mixed reaction coming in when it comes to the city gas distribution companies, because MGL is up around 2.6% and moves are also seen in IGL stock as well. Select exchange related counters. There too we are getting to see some bit of an interesting moves right there, because stocks like BSC, MCX, they were seen to be falling, and even today these stocks are a bit under pressure. So quite a mixed move when it comes to the broader markets, but the breadth of the market, Snehi, is very much cheerful, especially with respect to the advanced decline ratio. That's a sign of relief.
Absolutely, sign of relief indeed, given the way the small cap index has performed last week, a 3% cut there, and the bashing that it has seen in the last two trading sessions. A recovery looks good today. But let's shift focus and start interacting with the managements that we have lined up for you on the show. First up, let's understand the impact of the rate cut on the banking space, and in particular City Union Bank. We have the MD and CEO, Mr. N. Kamakodi, joining us on the show. Good morning, Mr. Kamakodi, and thank you so much for your time. Let's start by talking about the rate cuts. How much pressure will this put on your margins, given that this repo rate cut has now been announced by the RBI? How does your margin stand to be impacted?
Yeah, as we had discussed in the earlier con call and also our communication with the market, so the 50 percentage repo cut in the earlier time, in fact, had higher pressure when the yields had to be, like say, adjusted quickly than compared to the deposit rates. Those things, in fact, we said we will be having margin pressure in the Q2, which will get normalized in the third quarter. So, in fact, we could even have a reasonably good margin in the Q2, and we had communicated that overall our margins for the remaining quarters will be plus or minus 10 basis point, whatever we had in the Q2. And we continue with the same, let's say, predictions, whatever we shared, and we are reasonably good with the margins even after the 25 basis point rate cut, which will be within that plus or minus 10 basis point, whatever we have communicated in the past.
All right. Hi, morning, Mr. Kamakodi. This is Srishti also joining in. But when the NIMs will moderate, give us some sense there. When can we see moderation of this particular number, and what will be the timeline for the growth?
Overall, we predicted that whatever net interest margin, that plus or minus 10 basis point, the stability has already come in terms of net interest margin. Hope that this will be the last rate cut before the end of the current financial year. With that prediction in hand, we hope to complete the current financial year 25-26 with that existing stable net interest margin, what we have communicated with plus or minus 10 basis point. So we are hopefully good with that. In terms of growth, we had always predicted about 2 to 3 percentage point over and above the growth rate of the industry, and we had about 18%, much higher than whatever we had predicted in the past, and also in tune with the growth rate of the industry. That is mainly because, apart from other factors, we started secured retail through housing loans and other loan against properties and all. So we started last year when we said, let's say, we will be breaking even in the current financial year, and it will be adding profitability in the next financial year. That has added about 2 to 3 percentage point extra growth for our current year, and we hope we should be able to continue with our prediction of about 2 to 3 percentage more than the industry growth rate, which will get our growth rate close to, let's say, 15-16% for the year as a whole.
Okay, and Mr. Kamakodi, help us understand the impact of this rate cut on your advances. What kind of growth or boost can we see in the, can we expect to see in advances on the back of this rate cut?
We don't expect any significant increase beyond whatever we had shown in the previous quarter. The overall, we will get a clear picture when we get into the Q4. So we are still continuing with our existing growth predictions, which we shared that 2 to 3% over and above the growth rate of the industry, where we expect about 12 to 13% for the industry growth, and we should be having about 15 to 16% growth for the year as a whole.
All right, but which business segments are expected to perform better? If you can give us some sense there.
Our main loan book composition comes from the MSME sector, wholesale and retail trading, agriculture, including the gold loans. Gold loans constitute about 30% of our overall loan book, and we are able to see growth across all segments with improved asset quality, where the SMA 0, 1, 2 numbers together for us have come down significantly from our earlier track record. We have a very low base in the secured retail, particularly the housing loan and the loan against property, which we started recently. All put together are having, let's say, reasonably good growth with reasonably good asset quality numbers. We have been consistently seeing our NPA slippages below the NPA recovery front, which has shown our both gross and net NPA, showing step-by-step reduction for the past maybe not less than 6 to 8 quarters. We expect the trend to continue for at least another 2 to 4 quarters going forward, and we are pretty confident about both the growth, asset quality, and margin in terms of our loan book.
Okay, and also help us understand how is the MSME portfolio shaping up and what is going to be the growth trajectory there?
So the existing percentage composition, let's say, is stable, and we are able to have 40% plus from the MSME segment itself. While that we hope to see that stable and growing with close to the growth rate of our overall loan book, and the asset quality front also it is showing significant improvement. We are after the corporate investment cycle. We expect the investment cycle in the MSME will also start. So the financial year 26-27 will be reasonably good for the MSME, is our prediction, with which we are making all our existing infrastructure to fulfill the requirement of the market.
With that, talk to us about the recoveries, because recoveries exceeded the slippages. Was it expected to continue going ahead? What's the outlook, and how much recoveries are expected in quarter 3 and quarter 4? If you can help us with some number.
In fact, I mean, just to give you a perspective on the, I mean, it is very difficult to exactly give you the numbers for the quarter-wise, but we can definitely give a trend about the how things are happening over, let's say, multiple quarters and the financial year as a whole. In fact, year after year for the last 2-3 years, we are seeing about 100 crore reduction in the net slippages for the year as a whole. So we expect the year as a whole, the total slippage for the current year to be about 700 crore, vis-a-vis about 800 crore what we had in the previous year. So we had almost 50% of that slippage in the first 2 quarters, and we expect to see the same trend for the Q3 and Q4. The NPA recoveries from our pool. In fact, there was a let's say a delay in the NPA recovery post COVID because of, let's say, the legal the debt recovery tribunals and all. Let's say there was a backlog there, and those things are now getting cleared up quickly. So that backlog is now getting cleared. Because of that, the recoveries will cross whatever we had, whatever we will have for the slippage for the year as a whole, which we expect to be around 700 crore.
Okay, Mr. Kamakodi, thank you so much for joining us with that, and good to be chatting with you today. On that note, we'll slip into a very short break. Be right back with more news and updates and the management of Satin Credit Care on the other side of this very short break.